Ladies and gentlemen, good day and welcome to RBL Bank Limited Q4 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. R. Subramanian Kumar, Managing Director and CEO of RBL Bank. Thank you, and over to you, Mr. Kumar.
Good evening, ladies and gentlemen, and thank you for joining us for a discussion on the RBL Bank's financial results for the fourth quarter and the full year of FY23. I am, as always, joined on this call by Mr. Rajiv Ahuja and other members of our management team, who along with me will address any questions that you have. I briefly want to touch upon a few of the key items from our business performance this year. Firstly, on growth. At the start of the year, we had planned for 15% growth in advances and annualized growth in our retail business of 20% this fiscal. I am happy to report that we have ended FY23 with a 17% YOY growth and a 5% sequential growth in advances. Retail advances grew by 21% YOY and 8% sequentially. The wholesale advances grew 13% YOY and 2% sequentially. We had planned to grow the commercial banking business within the wholesale business, and this segment grew 19% YOY and 4% sequentially. Momentum in the retail businesses has continued to improve with every passing quarter. Our disbursals across all our retail businesses, other than the cards, was approximately 4,400 crores this quarter, as against 2,700 crores last quarter. For context, we started this year with approximately 700 crores in Q1 FY23. While microfinance growth has been a big driver of this growth, and it is now at 800 crores monthly disbursal rate. It has been particularly heartening to see that the disbursals in our newer verticals of housing and vehicles has been steadily increasing every quarter. Housing, in fact, saw a disbursal of 900 crores this quarter, and the tractors is now at 300 crores quarterly run rate. In cards, we saw an issuance of 5.5 lakhs this quarter. On deposits, we saw a 7% YOY growth in overall deposits and a 4% sequential growth. CASA deposits grew 14% YOY and 6% sequentially. CASA ratio was 37.4% and retail and small business deposit ratio as defined under LCR was 42.8% as at March 31st, 2023, as against 42.5% last quarter end and 38.9% last year. We have spoken in the past of our focus on utilizing the surplus liquidity and prioritizing the granular deposit growth. Our retail and small business deposits, as defined under LCR, has grown 18% YOY and 4% sequentially. Deposits below 2 crore has grown 19% this year and 5% sequentially. This continues to be a key priority for us. On profitability, I'm happy to report that we have clocked our highest ever quarterly and annual profit this year. While we have a long way to go and will improve on this in the coming quarters, this is an important first step as we return to full normalcy in our business and profitability journey. Our profit after tax for this quarter was 271 crore, an increase of 37% YOY and 30% sequentially. We reported an ROA of 1% this quarter, up 22 bips from the last quarter and last year. Our full year profit was 883 crores as compared to the loss of 75 crores last year. On asset quality, our GNPA and NNPA are lower QOQ at 3.37% and 1.10% respectively versus 4.40% and 1.34% respectively. last year, and our provisioning coverage ratio is at 68%, similar to last quarter. We had a total slippage of 681 crores this quarter. Recoveries and upgrades was 385 crores. Our net slippages were therefore 296 crores as against 383 crores last quarter. Slippages also include the impact of out-of-order circular of Reserve Bank of India. Of the slippages, 116 crores pertain to the slippages from wholesale and the recoveries and upgrades of 130 crores, so that the net slippage was negative. Microfinance, our slippages were 71 crores and recoveries and upgrades 32 crores, and our net slippages were 39 crores. In cards, we had slippages of 238 crores and recoveries and upgrades of 37 crores. Net slippages are flat sequentially. Our slippages in other retail was 257 crores, of which 96 crore pertain to the impact of out-of-order circular of regulator. And subsequently, they were upgraded. Net slippages in retail were 70 crores because of upgrades and recoveries. Our net restructured advances stood at 1.21%, down from 1.44% in Q3 of FY23. Provisions. We took total provisions and advances, which is NPA, restructured and standard assets provisions, all put together, 284 crores in this quarter, as against 339 crores last quarter. We had recoveries from written-off accounts of 103 crores. The net provisions and advances, therefore, was at 182 crores as against 244 crores in the last quarter. The credit costs for the quarter were 29 bips as compared to 39 bips in the last quarter. In summary, we are seeing a stable asset quality and good recovery trend. Our provisions this year were 900 crores, less than the third of our provisioning in FY22 and much below our initial guidance. This has been a welcome outcome given our strong focus and investments in strengthening the collection infrastructure. We continue to see steady recoveries, especially from our historical NPAs, and this trend should continue for a few more quarters. Briefly on other aspects of our operating performance. YOY NII grew 7% and 5% sequentially to 1,211 crores. Our NIMs this quarter was 5.01% as against 4.74% last quarter. For the full year, the NIM were 4.67%, which is 22 bips higher as compared to the last year. Other income was 674 crores for this quarter, higher 32% YOY and 9% sequential. Core fee income grew 28% YOY and 11% sequentially to 658 crore. For the full year, other income grew 6% to 2,489 crore, and the core fee grew by 12% to 2,323 crore. Total revenue was 1,885 crore for the quarter, higher 15% YOY and 7% sequentially. For the full year, total revenue was 6,941 crore, up 9% YOY. Our OPEX this quarter was 1,292 crores, sequentially growing at 8%. For the full year, our OPEX was 4,738 crore, up 31% YOY. PPOP this quarter was 594 crore, up 5% sequentially. For the full year, PPOP was lower 20% at 2,202 crores. We are, however, now on an improving trend on operating profit, and we expect this to continue going forward as business momentum continues to improve. Consequently, the profit after tax was 271 crore for the quarter, which is 37% higher YOY and 30% higher sequentially. The board of the bank has also proposed a dividend of 1 rupee 50 paisa per equity share, subject to the approval of shareholders of the bank. Lastly, on capital. Our total capital was 16.9% and our CET1 ratio was 15.3% as at March end, as against 17% and 15.5% as at December end. Before we conclude, I want to share a few thoughts on our journey ahead. We have recently finalized our 3-year plan for the period 24 to 26, and we have shared some of the details in our presentation, which is uploaded into our website. Our plans for the next 3 years are centered around the following pillars: granularity on both sides of the balance sheet, the growth of balance sheet, customer base, distribution footprint, the financial prudence and improving earnings predictability by scaling up newer business verticals at a faster rate, leveraging infrastructure and organization design changes to drive customer-focused approach, leveraging existing infrastructure effectively and a greater cross-sell, maintain focus on asset quality and collection efficiency with a strong processes and monitoring mechanism, sustainability focus at the front and the center in lending practices, talent management and employee development and governance practices, growing granular advances and deposits. One of the key lessons we learned was our capacity to absorb large ticket shocks was limited. We are therefore driving growth by growing granular advances in both wholesale and retail. On our overall basis, we expect to continue to see granular advances and deposit growth of 20% plus annually for the next 3 years. Bulk of the growth will be driven by retail as we look to scale up our newer business lines while sustaining the growth momentum in our existing business of credit cards and microfinance. The new businesses of housing, small ticket mortgages, vehicle, gold, and MSME loans are expected to account for 25 to 30% of the overall advances mix at the end of our 3-year cycle. This means that the growth in these new business lines would account for roughly half of our overall advances growth in this period of 3 years. In our wholesale business, while we may grow the advances book normally, we will scale up our commercial banking and supply chain business within the overall mix as we look to the bank clients which make more economic value. The objective for this cycle is improve our market position in both credit cards and microfinance, scale up the newer businesses at a faster pace to reach a critical mass and faster break even, invest in self-sourcing to reduce the dependency on external sourcing. On the deposits front, the key objective is to improve the share of granular retail deposit. Retail deposits will account for the bulk of the deposit growth in this cycle and fund majority of our advances growth. Today, deposits below rupees 2 crores are approximately 42% of our deposit. We plan to accrete at least 3% annually so that the retail deposit accounts for 50% plus of the overall deposits by the end of the cycle, which means they will grow at about 20% in this period. This will be driven by investing in the distribution and the people to supplement the current branch network by 50 to 75 branches every year and in RBL FinServe at a similar rate. Leveraging our existing infrastructure. The more important journey for us to leverage our existing setup more fruitfully. We today have 821 distribution points of RBL FinServe and 517 bank branches, which today are focused on a single product. RBL FinServe focuses on microfinance lending, while our branches are largely liability and third-party income focused. Driving liability and asset sourcing from these locations and ensuring cross-sell, upsell of the other logical products will be the key driver of generating operating leverage, and that is a task we have set ourselves. Similarly, while we have done a good job of building the businesses such as the microfinance and credit card and recognized payment businesses, within these business we shall undertake cross-sell and upsell, which will increase the pace. Driving the cross-sell to improve the customer stickiness, lower the cost of acquisition, and improve the branch profitability, and the customer wallet share will be the important objective in my mind. To achieve all that I spoke about, we have a sufficient management depth at a senior and middle levels, and have also taken a multiple steps in the last year to further beef up our depth in the key functions. The financial outcome of all this is an improving profitability trend on an ongoing basis. We exited this quarter at 1% ROA. The next goal for us to keep improving this by 10 to 20 bips each year. I'll stop here, and with this, we will now take the questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jai Mundra from ICICI Securities. Please go ahead.
Yeah, hi, good afternoon, and thanks for the opportunity, sir. And thanks for the detailed vision under FY23 to 26 goal. So first question pertains to that, sir. While it is good to have aspirational target for the medium term to understand the direction, but do you think that for FY24 also you can deliver 20% plus kind of a growth in the background of, systemic moderation in the credit growth to maybe 12-13% kind of a number?
Yeah. Thanks, Jemendra. See, as far as the FY24 is concerned, we have said about the FY23, we said that we are establishing some practices in retail. All these will start delivering in this year. That's why I said the retail will grow to the tune of around 25 to 30%, whereas our other existing product will continue to grow around 15 to 18%. Both will average out to 20%. We have plan of action for that, and we have already established practices as well as the processes to achieve this.
Right. And sir, on your core businesses, right? So you have mentioned that you will keep delivering on the core businesses. This you are referring to credit card and MFI, right? And is there any other business that you are referring when you say core businesses? And what should be the share of these core businesses?
See, when I said about core businesses, the businesses which are established and started rolling out, which consisting of our commercial banking, credit card, and microfinance. If you look back at that microfinance, which was just having a negative growth of 36% in the beginning of the last year, has now started growing at the fast pace of around 20-22%, which will continue to grow the same rate. The credit card, which is growing at around 24-25%, will continue to grow at 20-24%. Last year, the commercial banking grew at 19% because with this base of around 7,000 crores, it still has an ability and growth and the capacity to grow at the same pace. So these are three things which I said about the core. And now maybe in another half year, the core business will include our housing loan, because which is also now gained around 88% than what it was earlier. Then LAP and other things will also be going to contribute to this core.
So Jai, one more point. I think we are, systemically we have barely 5.5% market share. So I think system growth of 12% and 16% will impact us much less given our size and scale as compared to much more scaled banks.
And the last question is, sir, when you are still in the investment phase, let us say you are still rolling out new products and maybe tapping new geography, and all these are retail, secured, probably high cost intensive products. The OPEX growth should still be similar or marginally higher than loan growth. Right? Is that a right assumption to make?
See, the OPEX growth will more or less remain at the same. Yeah, I'll just give an example of C&I. The OPEX growth. Now, one thing what we have done, we have front-ended in creation of the retail franchisee across the branches, across the verticals. Excepting for the small bump up, maybe in a two-wheeler and four-wheeler, all other things have already been implemented, or it is now going to the time for them to deliver. Today, all these front-ended things have been done partly to the extent of around 80%. There will be a margin increase in the OPEX cost as we move forward, but it will not be much higher than what has been done last year. Last year consumed most of the investments.
But Jay, yes, it will be more than loan growth. Yes, little more than loan growth.
Sure. And then the PPOP growth that you are targeting is because the revenue growth should be higher, which would also be a function of the fee also, or you think the margins these businesses would have slightly better margins?
No, I think it will be a combination of both margin expansion and fee income. Margin expansion driven by again better mix within wholesale as well as more retail growth overall than wholesale.
Right. Thank you, sir. Thanks a lot and all the best. I will come back.
Thank you.
Thank you. The next question is from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. The first one is on the Zomato partnership. Why did we nullify this particular co-brand partnership and go ahead with Bank Bazaar? Is it some favorable commercials? That's the first. Second is that our revolver proportion has been around 22%, which is pretty range bound when we look at sequentially or even on an annual basis. How do we look at revolve growing in our own credit card book? And what kind of spend growth are we looking at in 24-25 with rentals getting capped because of various fees getting attached to the rental spend? These are my three questions. Thanks.
Yeah, I'll ask Vikram to respond to that. We have our credit card head.
Hi. So answering the first question first, which is like what happened on the Zomato partnership. Zomato strategically wanted to focus on their core business areas, and therefore they have taken a decision to not remain in ancillary lines of activity. It was neither commercial nor any other aspect of partnership, but just pure change in their own strategy. And that is the answer for the first one. Revolve rate is a macro after usually a little bit of a tough cycle. Whatever is the leftover pool, you see little bit lower revolve behavior. As and when we acquire new customers and portfolio momentum gains up, we will see it's getting balanced out. What was your third question? Will you just repeat it once?
Spend. Growth of spend.
Spend growth in 24-25. What is the estimate for us in 24-25 with rentals getting capped because of various fees getting attached to it?
Right. So if you were to look at it, actual spend increase between FY22 to FY23 has been tremendous because of acceptance of cards for unconventional categories like rentals, fee, this, that, and all. Banks have put fee, to balance this category of spend. My sense is that in last 4 to 5 years, the category is expanding at 20-25% CAGR. Therefore, 20-25% of growth in spends is likely to be seen, even after putting a fee and capping on the rental spends.
Thank you. Those were my questions. Thanks.
Yeah, thanks.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. The next question is from the line of Sameer Dalal from Unrivaled and Sons Stockbrokers Private Limited. Please go ahead.
Yes. So my first question actually has been answered to some extent. I mean, you said that your OPEX cost is going to grow marginally higher. Can you give some, will it be at the similar levels of 30% growth in OPEX, or will that start tapering off in the current financial year? And the second question has to do with credit costs. Yes, credit costs have been extremely good. They've come down quite a bit, but they're still a little higher than what we would like. So where do we expect credit costs to finish in the current financial year?
I'll just answer about the credit cost, and we'll ask my colleague to talk about the other one. See, the credit cost today in this quarter, it is hardly 29 bips, and it was last quarter 39 bips. Whole year is 149 bips. And we have been, we said that the credit cost will be in the range of 2.6 or so, and we also said that it will be 50% less than that of the previous year. We have just performed much better than what we have been getting it. And I don't think that this is an elevated position. Going forward, in the quarter on quarter, we will be in a position to do that, and conservatively, we have said it 2%, but it will be in the range of around 1.5% as we move forward. So it is not an elevated position, which we'll definitely appreciate. It is just
I'm saying you've done well on that front. What I'm saying is, what can we expect next year?
Yeah, next year we'll be in the same ballpark for 1.5 to 2%. Worst scenario will be the 2%, but we are aiming for closing it at 1.5%.
On the cost front, actually, we said it will be more than advances. It will be somewhere between advances and the current OPEX growth.
Okay. And lastly, on the credit card side, the NPA side, we've been seeing constantly higher slippages. Can you give us some guidance on how we can maybe work on something on reducing the credit costs that are coming, the NPAs that are coming through in the credit card business? That is where I think you're facing the bulk of the increase.
Yeah, when you said higher and higher, you're talking in absolute?
No, I'm not talking in absolute. I'm saying, compared to the rest of the verticals.
No. So credit cards as a business will typically run at somewhere around 4% credit cost. So it will have slippages. It is the nature of the beast. And after absorbing credit costs of 4% with the kind of slippages we are seeing, it is still a very profitable business. So it cannot be compared with, let's say, a housing loan as an example.
So you believe it will remain the credit card at 4%? It will not.
No, in fact, these numbers are already below pre-COVID for us. And if you look at the only listed player in this space, we would be similar or below. So it's, we believe we are already in the range where we should be.
Okay, thank you. We'll come back in queue for questions if we have more.
Yeah, okay.
Thank you. The next question is from the line of Sandeep Joshi from Unifi Capital. Please go ahead.
Hi. Thanks for the opportunity. So my call just got cut off in between, so I don't know if my question is specific. So my question is actual sustainability of margins. So we have
Sorry, sir, a lot of noise.
Sorry to interrupt here, Sandeep. There's a lot of background noise coming through. If you can move to a silent area, please.
I'll come back in the queue then.
Sure. We'll move to the next question from the line of Chintan Shah from ICICI Securities. Please go ahead.
Hello. Thank you for the opportunity. My question, sir, is also on the margins front. So given that the margins have been inching up almost in the past 4 quarters, and they are they are up like 70-80 basis in the past 3 quarters. So could you help me with what is the loan mix in terms of floating and fixed proportion for our book as of now, and what that was kind of 4 quarters ago?
So broadly speaking, if you look at our business, cards, microfinance, and parts of retail are fixed. So typically we'll have about 45% or so as fixed rate, and about 55% would be floating. Most of wholesale would be floating, and housing, LAP kind of businesses are floating. So it's approximately 45-55 between fixed and floating. And in terms of margins, we've had, one of the reasons why there have been tailwind on margins is, one is, of course, our, product mix has improved towards better yielding loan book. If you see, our retail proportions have gone up overall. Second, we have also gradually been able to reduce our excess liquidity on the books. If you see, our LCR used to be around 145-150%. We are now in the 120s. And third, we are still, most banks, including us, have benefited from higher repricing on the loan side, and the cost of deposit flow through is yet to fully come. So from here on, I think there'll be a little bit of a headwind on that particular factor, which should get, in our case, more than compensated due to the mix change that we still continue to see between retail and wholesale.
Okay. Yeah, so that was my second question, actually, on cost of deposits only. So given that our peak term deposit rate, if we compare to the larger banks, so that was roughly the differential was somewhat around 2.5% a year ago, and that has been reduced to around 1.5% roughly now. So that differential now, will that further increase to 2.5, or will it be stable at current levels?
So I think there are various reasons why it expanded in the past. I don't see any reason why we should be increasing the spread from here on. We will want to be competitive with our peer group, and we don't expect that, therefore, that gap to increase. Hopefully, over a 2-3 year period, it should further narrow.
So, and just one last question on the credit card trend. So the revolver rates, if you could just highlight what they were, and what are we expecting in terms of revolver rates for FY24? Also because of the fact that I think that the conversion to EMI trend also has been picking up, and is that being a determinant to higher revolver rates? And so do you believe that is a structural change, or would the revolver rates increase in FY24?
Hi, Bikram Yadav this side. Revolve rate earlier were about 300 to 400 basis points higher than the current level, and they are slowly inching up. As and when the business momentum and new issuance will pick up, my sense is that they should go up by 100-200 bips in the coming year. We have been seeing that on the portfolios, revolver and transactor were, moving from revolvers moving to transactors and transactor were moving to revolvers, EMI base has maintained at a certain level for a reasonable period of time and is likely to maintain in the coming year as well.
Sure, this is quite helpful. Thank you. I'll get back in the queue. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. The next question is from the line of Matthews John from Individual Investor. Please go ahead. Matthews, your line has been unmuted. Please proceed with your question. We don't have the current participant in the question queue. We'll move to the next question from the line of Prabal Gandhi from Ambit Capital. Please go ahead.
Yes. Am I audible?
Yes, you are.
So my first question is that with a blended yield of 7.5% on the wholesale book and cost of funds of 6%, how do we make money on the corporate portfolio?
Repeat.
Can you repeat the question?
Repeat, please. Hello, Mr. Gandhi, can you repeat, please?
Yes, sir. Sir, with a blended yield of 7.5% on the corporate book and with our cost of funds of 6%, how do we make money on the corporate book?
So in corporate, lending is, probably the least reason for making money. You have current account floats by getting cash management mandates. You have FX business. You have trade, guarantees, LCs business. You have salary accounts of corporate customers. You could do other asset businesses. So it is extremely narrow view to look at yield in wholesale to judge profitability.
So this is a dollar.
Would the ROA be...
And there is also an element of foreign currency in that blended rate. If we take a rupee yield of the wholesale book, we would be closer to 9%.
So would the ROA be greater than 1% in the corporate portfolio?
No, we would be ballpark there. So it depends. I think we've also had a particularly benign provisioning cycle in this year. For example, in this fiscal, the net provisioning cost for wholesale business is zero. Obviously, that's not a model situation. I mean, obviously, we have to budget some model credit costs. So in a scenario like this for us, yes, we are closer to that percentage.
So meaning in a benign credit cost scenario, our ROA is closer to 1%.
Yeah, you can take it like that.
So my second question is that, sir, on the deposit side...
Sorry to interrupt here. Before you proceed, if you can speak to the handset in case you're using earphones, because the voice is muffled.
Just a minute. Is it better now?
Yes, proceed.
Okay. Sir, on the deposit side, so if we adjust for the CAR float, our deposits on a sequential basis and on annual basis have hardly grown. And I understand that so far we had balance sheet liquidity, so we were not looking to grow our deposits that aggressively. But with the loan growth expectations going ahead, how do we manage our deposit growth?
See, there is one thing which we said in the beginning of the year itself, like we are not looking at that overall deposit. We wanted to migrate from that of the deposit, which is bulk in nature, to the granular in nature. You could have seen that the granular deposit has grown to the LCR deposit grown by 18%, and less than 2 crores deposit is also growing at a very, very comfortable margin of around 18%. We will continue to grow in that area as well. And now we have moved up. Previously, the multiple verticals were there in respect of cross-selling of our liability products. We had our microfinance and credit card, which was just selling one of the products. Now, in this year onwards, we have created a platform through which we are enabled the cross-sell of especially the liability product, which is primarily focusing on deposits to the people who are availing our credit card as well as the microfinance. The work has started. The second is we have already created a digital journey in respect of totally automated digital journey for fixed deposit, which is going to be one of the prime mover on our digital channel. So these additional channels, the BC channel and our branch channel, apart from the branch channel, our digital channel will be facilitators to augment more and more. Last year we were not aggressively positioning. As I said that we are looking for the granular deposit growth of around 20%, which with all the preparations we are confident of achieving it.
Okay, got it. Okay, thank you, sir.
Thank you.
All the best.
Thank you.
Participants, if you wish to ask any questions, please enter star and 1. The next question is from the line of Anand Dama from Emkay Global. Please go ahead.
Yeah, thank you for the opportunity. Sir, have you given any ROA guidance for next 3 years as well? Have you already achieved now 1%?
Your voice is not clear. Please use a handset mode. Your voice is fluctuating.
Yeah, hold on. Am I audible now?
Yeah. Yes, Anand.
Yeah. So basically, I was asking about the ROA guidance for next 2 to 3 years, if you can give.
Correct. I was just said in my speech also, we have exited with 1% and we continue to maintain that 1% as we move forward. We may again exit by another 10 to 20% more in this FY24. And the same way within 10 to 25%, we will be increasing it year on year henceforth.
Okay. And sir, any drivers for this ROA improvement? Is it mainly going to be the lower loan loss provisions, or you expect even the margins to pick up, or any other line item basically where from you expect this ROA expansion?
So the credit growth is one of the one which is also going to grow it, and we also said that we are getting into such products which is going to give us a moderate to higher yield than what it has been doing it. We will continue to grow in our credit card and microfinance also. Last year the microfinance number was somewhere around 4,000 crores. Now we closed it somewhere around 6,000 crores, which will continue to grow. So these will be the contributor to our income, which in turn, apart from our guidance with regard to the credit cost, which we want to cut it down, these two things will continue to contribute. Anything else?
Oh, yeah, I think we will have the opportunity to get more efficient on the balance sheet. So we will, there was excess liquidity situation last year, which will come down. We are also changing the mix within wholesale towards more commercial banking, less corporate banking, which will be more profitable as well. And credit costs, I think I would probably say that this year was the lowest. It is unlikely we'll go lower than this. So, so the drivers have to be things other than credit costs.
And secondly, sir, there were some accounts which were there in pipeline as far as the resolutions are concerned. For example, McLeod was there, CCD is there. So any developments over there?
We continue to work on all these accounts. I mean, it is not the question of 1 or 2 accounts. All the entire portfolio is being worked on a continuous basis. You would have seen that wherever the recovery is there, recovery has been told. So working on it, yeah.
So Anand, on an overall portfolio basis, as I mentioned, the wholesale banking this year has had negligible to nil credit costs. And given the visibility for recovery next year and the theoretical visibility for slippages, we expect a similar outcome next year for wholesale banking.
Okay, thanks. Thanks, Chandra.
Thank you. A reminder to all the participants, please enter star and 1 to ask a question. The next question is from the line of Smriti Chaudhary from BQ Prime. Please go ahead.
Hi, thanks for the opportunity. Am I audible?
Yes.
Hi. I just wanted to ask 2 things. First is the provisions in this quarter fell 41% year on year. I wanted to know the rationale behind it. And if you could talk a little bit about the core income, the increase in core income from the previous year. The growth is only about 7%, I think. So could you elaborate on it a little bit?
72%.
Yeah. So on the provisioning fall last year, of course, we were still reeling under the lagged effect of COVID. So all businesses of the bank now are, two things. One is lower slippages on an incremental basis, and the recoveries from the past stock also helps in reducing the provisioning. So that is the reason why provisioning has come down substantially, and that has been the story for most of the current year. And we will expect now to be in a stable range going forward. On core fee income, basically, our loan growth has been in the 17% range, and therefore, last year we had the benefit of one-off treasury income because yields had fallen quite substantially, and that opportunity has been far less this year. So that is one reason for overall income to be down.
All right. Thanks a lot. Thanks.
Thank you. Participants, if you wish to ask any questions, please enter star and 1. The next question is from the line of Sumit from Morgan Stanley. Please go ahead.
Hey, hi. Hello, everyone. Sumit here. Congratulations on a good quarter. Just one or two questions. So one is on GNPL coverage ratio at 68%. Is that a comfortable level, or at some point of time you would want to improve that as well?
We have just anchored not to go below 65%. Around 68 to 70% is the normal range in which we wanted to operate on.
So Sumit, just to add, I think we still have a reasonable portfolio from our business loans which are fully property backed, which our policy has a 15% provisioning there, and then it goes to 25% next year. But typically these get resolved at pretty much zero principal loss in 12 to 18 months time. So, if you exclude that portfolio, then the PCR would be higher. See, look at our portfolio. We provide cards in 180 days. We provide microfinance in in a year. And if you look at our net NPAs across segments, which we have given in the presentation, if I were to put some reasonable conservative thoughts around LGDs, I think we will be more than provided for.
Very helpful. And Jaideep, what would be the threshold CET1 ratio that you would want to operate with, given that RBL, unlike some of the other banks, operates with somewhat higher unsecured loans? So just trying to get the threshold for CET1 that you would want to operate with.
So Sumit, I think, so we are obviously very comfortable today, and we don't see the need for raising capital at least for the next 18 months or so. And we don't expect, therefore, in that period to fall below 14.5%.
Okay. Thank you. That's it from my side. Thanks a lot, Jaideep.
Thank you. We now conclude the Q&A session. If you have any further questions, please contact RBL Bank Limited via email at ir@rblbank.com. On behalf of RBL Bank Limited, we thank you for joining us, and you may now disconnect your lines.
Thank you so much. Thank you.